Hello everyone. Today we are going to discuss about Form 4684 Casualties and Thefts. Form 4684 is used to report gains or losses from casualties and thefts that occurred because of a federally declared disaster and which may be deductible for taxpayers who itemize deductions. Taxpayers who live in federally declared disaster areas do not need to itemize deductions in order to file Form 4684. A casualty loss can result from damage, destruction, or loss of your property from any sudden, unexpected, or unusual event such as a flood, hurricane, tornado, fire, earthquake, or volcanic eruption. Who can file Form 4684 Casualties and Theft? Taxpayers reporting gain or losses from casualty or theft should file Form 4684. Homeowners who received notification on the need to tear down or move a structure after a federally declared disaster may use Form 4684 to claim a loss. These individuals may claim the difference in the home's value pre and post event. However, the owner must receive notification from the building authority within 120 days of the declaration of the disaster area. Casualties and theft of personal property are only deductible if they can be attributed to a federally declared disaster. The IRS allows an exception to this rule for individuals who have personal casualty gains. In this case, the taxpayer can use casualty and theft losses not attributed to a federally declared disaster to offset the gains. Taxpayers who live in federally declared disaster areas do not need to itemize deduction to file Form 4684. Taxpayers cannot use Form 4684 to deduct expenses related to personal injuries. The Form 4684 is available on IRS website. In most cases, the form only applies to personal losses, not for casualties and thefts related to business property. Once you have determined that your casualties or thefts qualify for a deduction, complete Form 4684 and either attach it to your return or to an amended return for a past claim. To deduct federally declared disaster losses for the preceding tax year, complete Section D of Form 4684. Special considerations when filing Form 4684. Form 4684 allows a deduction for non-reimbursed losses from specific events. Deductible casualty losses generally must result from an incident that is sudden, unexpected or unusual and took place during a federally declared disaster. Casualties include natural disasters such as earthquakes, fires, floods or storms. Other types of catastrophic events, vandalism, car accidents and shipwrecks. Provisions are also in place to assist those suffering loss from corrosive drywall and specific caustic concrete. Even the loss of deposits in some financial institutions which become bankrupt or insolvent can sometimes qualify as a casualty. There are specific circumstances for the deduction of loss from events such as Ponzi schemes. Section C of the Form 4684 contains information to complete deductions for such financial losses. However, damages alone may not qualify as a deductible casualty loss. For example, damage to a home from termite infection or invasion of molds or fungi is not considered a casualty loss because such destruction is the result of an ongoing process, not a sudden event. Also, a car accident may result in damage, but those losses are not deductible if the taxpayer was willfully negligent in causing it. Though theft losses may include incidents of larceny, embezzlement. These losses qualify if the theft is a crime in the state the event occurred and if someone acted with criminal intent. Fraud may be considered theft in certain circumstances. However, if losses in the result of a decline in the price of a company's stock because of illegal misconduct on the part of the company executives, damages may not be deductible. However, these losses can result in a capital loss, which can offset a taxpayer capital gains or reduce taxable income. Form 4684 Federal Disaster Area. Section D of the IRS Form 4684 applies to federally declared disaster area losses. Although casualty losses are usually deductible only in the tax year in which those losses happen, special provisions exist for qualified disaster losses. Losses from federally declared disaster areas have allowances to be deductible in the previous tax year and provide additional tax advantages. For an event to qualify, the loss must fall into specific geographically declared disaster areas. According to the IRS, for the tax year 2020, a qualified disaster loss is now expanded to include an individual's casualty and theft of personal use property that is attributable to major disaster that was declared before February 26, 2021 by the President under Section 401 of the Stafford Act and occurred on or after December 20, 2019 and on or before 27 December 2020 and continued no later than January 26, 2021. However, this change does not include those losses attributable to a major disaster that has been declared only by reason of COVID-19. Now, how to figure out your deduction amount? To figure out a deduction for a casualty or theft loss, first figure the amount of your loss, then follow this instruction to fill out Form 4684. Figure your adjusted basis in the property before the casualty or theft. Figure the decrease in the market value (FMV) of the property resulting from the casualty or theft from the smaller amount in Step 1 and Step 2. Subtract the insurance or the other reimbursement you received or expect to receive. You will need to prove a casualty caused your loss. So keep newspaper accounts and other proof showing the type of casualty that struck your area and the amount of damage it did. To prove the amount of your loss, you should have purchased receipts of the affected property, receipts for improvement made to the affected property, pre and post casualty appraisals for the affected property. If these records were damaged or stolen, the IRS states you may use other satisfactory evidence to prove or support it. Casualty loss or theft of business or income producing property. You can no longer claim any miscellaneous itemized deductions. As a result, business casualty and theft losses of property used in performing services as an employee cannot be deducted nor applied in the netting process to offset gains. You might suffer a casualty or theft loss to property used in a business like a vehicle or rental property. If so, you don't have to deduct or reduce the loss amount by the $100 deduction, and the 10% of AGI rules don't apply. To figure the loss amount, subtract these items from the property's adjusted basis: salvage value, insurance proceeds, or the other reimbursement. You will take the loss on Form 4684 Section B. For tax years prior to 2018 and after 2025, you can only deduct casualty losses not reimbursed or reimbursable by insurance or other means. You will need to subtract $100 from each casualty or theft loss of the personal property. The total of your casualty and theft loss on personal property must be more than 10% of your adjusted gross income, because only the amount above this limit is deductible. Now, I will show you the Form 4684 in our software Drake. You can type here 4684 or I am showing you another way, or just click itemize deductions schedule. Okay, it's better to use that way. 4684 Casualties and theft. Okay, so this is the form which is showing the software. So you have to provide the type of the property code, like personal property, business property, income producing property, whatever property. FMB code lookup, qualified disaster loss, casualty number, casualty name, date occupied, cost of, location of the property, street address, everything you need to provide here, fair market value before the incident and after the incident. Maybe I need to provide some more information. Let's see. Guys, you can see form 4684 is flowing. So you need to provide the sufficient information to flow this form. Or to generate this form. You can also check here on schedule A. Here you can see line number 15, casualty and theft loss. That's why I look in schedule A if there was any option to report from there, from schedule A. But it's okay. You just have to type 4684 and it will show you the form, and you just need to provide all the required information on the form. So you can see nothing is deductible after all the calculation is done. So before wrapping up, I'm just quickly repeating what I have discussed earlier. So basically 4684 is a form used to report gains or losses for casualties and theft that occurred because of a federally declared disaster and which may be deductible for taxpayers who itemize deductions. Taxpayers who live in federally declared disaster areas do not need to itemize deduction in order to file Form 4684. A casualty loss can result from damage, destruction, loss or of your property from a sudden, unexpected and unusual event such as a flood, hurricane, tornado, fire, earthquake or volcanic eruption. Taxpayers reporting gain or loss from casualty or theft should file Form 4684. Homeowners who received notification of the need to tear down or move a structure after a federally declared disaster may use Form 4684 to claim a loss. These individuals may claim the difference in the home's value pre and post event. However, the owners must receive notification for the building authority within 120 days of the declaration of the disaster area. Casualty and theft loss for personal property are not only deductible if they can be attributed to a federal declared area. Form 4684 is available on IRS website. In most cases, this form only applies to personal losses, not for the casualty and theft related to a business property. So guys, I believe you have understood 4684. Goodbye.